All right, today we're going to dig into the Q4 2025 earnings for AudioCodes. Now, on the surface, the numbers looked pretty decent, but the way the market reacted, well, that was a whole different story. So let's get into it and figure out what on earth was going on.
And yeah, this is what we're talking about, a drop of nearly 14% in just one day. Ouch, that was the market's swift and, you could say, pretty brutal verdict on the quarter. The big question is, why?
To really understand that huge drop, we've got to look at the massive disconnect between the headline numbers they reported and that violent reaction from investors.
Okay, so this is where it all gets a little confusing. I mean, look at this. The company seemingly did exactly what it was supposed to do. They hit their non-GAAP earnings per share estimate, right on the money. And they even beat revenue expectations. You know, normally this is the recipe for a pretty good day in the market, not a total disaster. This really brings us to the absolute core of our analysis here. If those main numbers were solid, what did the market see that it just hated so much? What was hiding just beneath the surface of that revenue beat? And here it is. This is the smoking gun. When you look at the GAAP numbers, the really strict by-the-book accounting, the company's ability to actually make a profit just completely fell off a cliff. We're talking about a drop from 22 cents a share this time last year to just 7 cents this quarter. So even though revenue was up a little, the actual profit they generated cratered. That's what sent investors running for the exits. So this leads us to the central tug-of-war that's happening with the AudioCodes story right now. You've got management on one side telling this exciting story about high-growth AI, but you've got the market on the other side, totally fixated on the cost of that growth, that very real drag it's putting on their profits. Now, management spent a ton of time on their earnings call highlighting this number. Annual recurring revenue, or ARR, grew a solid 22% year over year. For any company that's trying to pivot to a software subscription model, ARR is everything. It shows you predictable revenue for the future. This is the big piece of evidence they want you to focus on to show the new strategy is working. And this quote from the CEO, it just perfectly captures their entire vision. They're trying to send a clear message, hey, we're not a dusty old hardware company anymore. They're rebranding, reframing themselves as a key player in the whole voice AI space. This is the story they're selling to Wall Street. But this chart shows the painful other side of that story. That 22% growth in recurring revenue is expensive. Their non-GAAP operating margins got squeezed and squeezed hard, falling from over 12% all the way down to 8.6%. It basically shows that every new dollar of that fancy AI revenue is costing them a lot more to bring in, and that hits the bottom line directly. And as if all that margin pressure wasn't enough, they also flagged another little headwind for the coming year, an estimated $2.3 million hit from tariffs. It's not a company killer, but it's another small cut that just adds to those bigger concerns about profitability. Okay, so that's our breakdown of the quarter that was. Now let's switch gears and look forward. We'll start with the company's official guidance and then talk about what we're going to be watching for on the next earnings call. So here's the official outlook for the full fiscal year 2026. They're guiding for some pretty modest single-digit revenue growth. Their non-GAAP EPS is basically going to be flat to maybe slightly up from 2025. The one bright spot, of course, is that they expect that strong ARR growth to continue. So it's not exactly a heroic forecast, but it does signal some stability. So what are we watching for next time? Well, it's simple. It all comes down to one word: profitability. The market has heard the AI growth story over and over. Now it needs to see that story actually translate into better margins and real earnings growth. Until that happens, skepticism is going to be the name of the game. And as for the stock price, well, we expect it to be stuck in a rut for a while. It's caught in that tug-of-war we talked about. The bulls love the AI growth story, but the bears are pointing at those shrinking margins. The stock probably isn't going to make a big move in either direction until there's clear proof that profitability is finally heading back up. So, putting all of that together, our official rating on the stock is market perform. Look, the pivot to AI is interesting and that ARR growth is real, so we're not bearish on the company. But at the same time, that severe margin compression makes it impossible to be bullish right now. It is the classic definition of a wait-and-see story. Now, for a final thought, let's talk about a potential outlier trade idea. First, the thesis. What if the market is so focused on the short-term margin pain that it's completely ignoring the long-term value of this growing voice AI business?
The catalyst could be just a single quarter where ARR growth stays strong, but the margins just stop falling. They don't even have to go up, just stabilize. That could be enough to trigger a sharp re-rating of the stock. And finally, the pitch, and this is a speculative one, would be to look at long-dated out-of-the-money call options. It's a high-risk, high-reward bet that this pivot works and that it works sooner than the market currently thinks. This is not financial advice.